everyone, and welcome to the Adjusted for Risk podcast here from the shores of Lake Tahoe. Today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. This week, it was a big week for separately managed account managers as Zephyr announced the 2022 PSN Top Gun Managers of the Decade. It was obviously quite the decade for financial markets and the world in general, not just financial markets. You know, when thinking about some talking points and about the past decade, you know, something like this, it just makes you sit back and think, wow, these events will go down in the history books. And it reminds you just how crazy some of the events were. It makes you wonder, am I lucky that I lived through this? Or maybe not so fortunate that you lived through some of these events. But they definitely will make you rethink. And, you know, as past decades, some of them events such as Donald Trump winning the presidential election doesn't seem like it was that long ago. So with that, it was a decade driven by political events, a pandemic, and historical monetary policies. The past decade, it's going to be remembered for its overall strong U.S. equity returns. The Russell 3000 index posted just over a 12% return, annualized return during the decade, as markets really distanced themselves from the great financial crisis. Historically accommodative monetary policies throughout the decade supported record high equity levels. The recovery from the great financial crisis remained strong during the early stages of the decade. Meanwhile, the worst year of the decade was the last year, when equities fell into a bear market and bonds experienced their largest drawdown on record as the Federal Reserve ended its accommodative policies and started its steepest rate hike cycle in 4 decades. So sandwiched in between the first part of the decade and the last year of the decade were a multitude of highs in first. It included unprecedented government intervention, record low interest rates, and eye-opening political events, all culminating in a risk-on environment as U.S. equities, represented by the S&P 500 index, posted a 12.5% a return during the decade. U.S. high-yield bonds, measured by the ICE B of A U.S. high-yield index, posted nearly a 4% return. Meanwhile, international equities, represented by the MSCI World X U.S. index, posted just over 5%. So they all posted strong returns during the decade, particularly domestic equities. So the first 7 years of the decade will be characterized by a slow economic growth and easy money due to historically low borrowing costs as the Fed tried to support the great financial crisis recovery. The decade started off strong as U.S. equities benefited from a recovering global economy and a risk-on investment environment. While experiencing their best year of the decade in 2013, developed equity markets, or the MSCI World Index, posted a very strong 27% return in 2013, while U.S. equities, or the S&P 500 index, reported a stellar 32% return in 2013. Meanwhile, 2013 will be remembered for the taper tantrum that was set off by the Fed catching bond markets by surprise when hinting that accommodative policies may soon come to an end, which resulted in a negative 2% return for the Bloomberg U.S. Aggregate Index during the year. Moving along to 2016, We'll all remember 2016 as political events defied expectations. The rise of populism led Britons to vote yes to leaving the European Union. Meanwhile, Donald Trump shocked the world by becoming the 45th president of the United States. Yields on sovereign debt hit all-time lows, and in some cases hit negative territory. Through all this political turmoil, equity markets remained resilient as U.S. equities, or the Russell 3000 index, finished the year up nearly 13% or 12.75%. It defied expectations when you consider all the political turmoil. Emerging markets, or the MSCI Emerging Market Index, posted an 11.6% return, while the EFI index posted a modest 1.5% return on concerns of what Brexit, the impact Brexit will have on the European Union. While the Fed started to tighten monetary policies in December 2015, the U.S. economy continued to expand due to fiscal stimulus in a historically strong labor market in 2018. As U.S. equities hit all-time highs in September, large cap growth, or the Russell 1000 Growth Index, posted a strong 17% return during the year. Meanwhile, small cap growth stocks posted a 15.75% return. And in the growth stocks led the rally during the first 9 months of 2018. However, that risk-on sentiment quickly changed towards the later half of 2018 as investors fretted over the Fed's rate hiking policy. Global growth, geopolitical issues, and trade tensions. Investors all had to contend with that wall of worry. And it was a growing wall of worry towards the end of 2018, which made them concerned that the Fed was hiking too quickly or too much. The early equity gains quickly turned to losses as all major global equity indexes finished 2018 in the red, led by the S&P 500 index, which finished a negative 4.3%. The EFI index finished down over 13%. And the emerging market index finished down over 14%. So due to the quick change in sentiment, investors flocked to safety and fixed income during the second part of the year, as short-term treasuries measured by the Bloomberg U.S. government 1 to 3 year index finished the year up over 1.5%. So we can't talk about the decade or discuss the past decade without talking about 2020, a global pandemic that resulted in a global economic shutdown as governments around the globe enacted shelter-in-place measures to try and stop the rapid spread of COVID-19 virus. These measures resulted in millions of unemployed in the U.S. alone. This short period of time was unprecedented for financial markets, as oil, measured by the WTI index, plummeted to a negative $37 a barrel. 10-year treasury yields hit 0.5%. Okay, no one ever thought they would see 10-year treasury yields fall under 1% or even 2%, but it did during the year. And the S&P 500 index fell a negative 34% in a matter of weeks. The turmoil, the uncertainty, all the concern regarding COVID-19 ravaged financial markets. However, strong and swift actions from the Fed and U.S. government helped stabilize markets as the S&P 500 index defied expectations again. Just like back in 2007 or 2016, the S&P 500 remained resilient on the heels of monetary and fiscal policies to finish the year up 18%, despite all the turmoil, and dropping a negative 34% earlier in the year. The broad equity index finished over 18%. Technology stocks soared as the Russell 1000 Growth Index finished the year up over 38% as consumers and businesses turned to technology during the stages of lockdowns when we're shuttered at home. So while the decade started off with a bang, it ended with a whimper. 2022 will be remembered for the beginning of the war in Ukraine and an end to the historically accommodative monetary policies that helped rescue the US economy and financial markets from the global pandemic. So not only did the Fed take away the punch bowl at the party, but it also started its very aggressive tightening policies to try and tame 40-year high inflation. And that was a result of very accommodative monetary and fiscal policies during the pandemic. So the Fed was forced to reverse course and try and change what it did to boost the economy and stabilize financial markets during the global financial crisis. The tightening of the purse strings led to reduced liquidity and an end to excessive exuberance. These tighter policies resulted in equity markets reaching bear market territory, and bond markets experienced their worst year ever. The S&P 500 index posted a negative 18% return during the year, while the EFI index fared a little better, not much, by falling a negative 14%. Meanwhile, bonds provided no haven for investors, as the Bloomberg US Aggregate Index fell a negative 13%, and the perceived safety of treasuries didn't help either, as the B of A US Treasury Index fell nearly 13% during that tumultuous year, as the Fed ratcheted or tightened monetary policies at its quickest pace to fight inflation and to try and cool the economy. And it impacted markets in a big way. So with that, as I said, it was a very eventful decade, and I'm sure it will continue. But here are some of the strategies that navigated the past 10 years to make the PSN Top Gun Managers of the decade. So here's just a few from the US large growth universe. AllianceBernstein's US large cap growth strategy posted a strong 15.7% for the decade. Night Owl Capital Management's Night Owl equity strategy also posted a 15.5% return for the decade. And Fiera Capital Corporation's large growth strategy posted a strong 15.3% for the decade. Move along to the international equity universe. Pacific Investment Management's Stocks Plus International Hedged strategy posted an 8.9% return for the decade. MFS Investment Management's MFS International Intrinsic Value Equity strategy posted a strong 8.7% return for the decade. In Comgest Asset Management International's Global X US equity strategy posted a strong 8.4% return for the decade. As for fixed income, we'll go ahead and focus on the high yield universe. McKay Shield's high yield strategy posted a 5.1% return for the decade. Barings US high yield bonds strategy posted a 5% return for the decade. And finally, BlackRock's high yield bond strategy posted a 4.8% return for the decade. So big congratulations. That's just a few of the many strategies that were awarded Top Guns of the decade. So a big congratulations goes out to all the PSN Top Gun Award winners during the quarter or during the decade. And thank you again for listening to this episode of Zephyr's Adjusted for Risk podcast. Again, you can watch previous episodes of the Adjusted for Risk podcast on Zephyr's Adjusted for Risk YouTube page, as well as Spotify. So thank you again, and have a great rest of your week.